the headlines that maybe some of you are reading or you're going to read in the next day or two, and it's saying the bond market blew up, right? But I just want to show you this right now. I'm going to show it from a 3 month perspective here. So what we're seeing is, if you can see, 2.953. This is the Canada 5-year government bond, up by, let's call it 19 basis points, but let's call it, let's call it 20 basis points. So it's a pretty big move in one day. 7-8% move in one day. That 0.193% is the yield. Okay. And the headline was it blew up. Okay. I- I'm going to give, I always tell people, like, when in doubt, zoom out. When in doubt, zoom out. But and I'll do that in a second. But like, what's the main headline that's telling people why this happened? And I'm going to give people a secondary headline that they might not actually be thinking about or reading. Okay. But the main headline about why this happened is you saw this spike up here. You saw the unemployment rate come down to 6.5%, and effectively that coming down to 6.5% dropped the odds of a rate cut from 75% to 50%. Okay, and that's what we're saying is, like, okay, if rates are going to be short-term rates are going to be lower, that also long-term bond rates will be lower too. And of course, the 5-year Canada government bond is important because it's kind of the basis for fixed rate mortgage products in Canada, where we have 5-year fixed rate mortgages. So a lot of people are getting fixed rate mortgages. This bond rate is more important than the overnight rate for people who are on variable rate mortgages. Okay. But I'm going to zoom out a little bit here and give people a bit of perspective. That's what we actually saw today. Okay. So when you zoom in on a 3 month basis, you're going to see some of these scary looking charts here. Here's a 1 month chart where it just looks like, bang, it's taking off to the races. And even 3 months probably looks a little bit intimidating. And then you look at 6 months, all of a sudden doesn't look so bad anymore. Okay. So that's a bit of the perspective that people are talking about. So Trevor, how much noise did you hear on your side today from the bond yields? Is there anything coming across the wires from the Dominion group there on um, fixed rate mortgages today?
There was a bulletin that came out, and I was so busy today I didn't get a chance to read what it said. But yeah, Sherry Cooper
Yeah.
had a bulletin that came out talking about the job market and the bond market and so forth. But I get a chance to read it. So my question is, like, what is it like? Our dollar is taking a hit right now. So how does that weave into all of this stuff with the price of bonds, and interest rates, as well as what happens with our dividend paying stocks?
I mean, it's, the lower rates are, the higher asset prices are in the long run. The system's set up to move the money from the people who do the work to the people who borrow money smartly to invest. So the cheaper they can get access to that capital, the higher that those asset prices go. But I mean, it was a pretty small move in the scheme of things. Has there been a weakness in the dollar? Yeah, there was weakness, and the lower an interest rate is, technically the weaker the dollar is going to be too. You're also just looking at a bit of a range too, because there's the generally speaking, you're only going to see the 5-year rate on the Canadian side and the U.S. side move within a particular band too. So you get a bit of that where they kind of move together. And I think a lot was made of, first I checked if there was any sort of new bond issuance on today. That's to say, like, we were actually having a marketability problem on the bond, like maybe they did a new bond issuance today, but it wasn't that. It was simply the labor market news, which I think is the first part of it, and I think that's going to get a lot of the headlines. But I'd like to draw people's attention to the second headline, or the second reason that I don't think is getting enough attention, is the fact that the Japanese bond market really is blowing up. And if I was to show you a chart of the Japanese bond market, you would actually see a real acceleration where Japanese bond markets are at 20, 30, 40 year highs, depending on the length of duration of the bond. And so what happens is that begins to unwind what we call the carry trade. And so historically, Japanese investors have been able to, or global investors have been able to borrow money cheaply in Japan and then buy other international assets. And people talk, a lot about them buying, U.S. treasuries or U.S. stocks, but they also buy Canadian stocks and Canadian bonds at the same time. It's a, relatively stable currency. And so you're seeing that, putting downward pressure on all asset prices now. And people often forget that, Japan is the third largest economy on planet Earth. And so when all of that capital gets pulled back because we know those investors can no longer borrow at, zero or next to zero in Japan and invest overseas, all of a sudden they're paying real interest rates. So they have to call that capital back to avoid being margin called. And that's putting downward pressure on everything. And you're seeing that. I think you see that in Bitcoin. You see that you've seen the volatility in the U.S. stock market, especially the high flying tech stocks. You've seen the pressure on the U.S. bond market, and now you're seeing the pressure on the Canadian bond market. And I think that's probably happening to a greater degree than people think. And I think a lot of it's going to be made about the unemployment rate. And I think that was a real kind of needle mover. I don't think people should ignore that, but I don't think enough is being made at liquidity is being sucked out of the international system and called back to Japan.
Right. Yeah, I was just looking at the report from Dr. Sherry Cooper, and yes, it talked about the jobs, and really let's discuss that a bit. The jobs weren't like major full-time jobs; it was mostly part-time jobs. But at the same time, it really helped the decline in the employment. Also made sure that the Canadian dollar is going up, and the interest rates are also probably going to go up, or at least stay the same. We're not going to have a decrease like we were thinking we're going to have in the interest rate. So.
Yeah, stay the same. I think the market is still predicting 50-50 at this point. So before it was 75% cut, 25% no movement. I don't think there's a high probability of an increase at all. I think it's more 50-50 cut
Mhm.
versus stay the same. But I think everyone is really ignoring from a large part the carry trade and the downward pressure on all international assets, Canadian bonds and Canadian stocks included. That is a real thing, and it'll continue to put downward pressure on the market. And and that's just what Japan has to do, because if they don't raise rates, if they don't keep their rates sufficiently high, all of a sudden uh, their currency could get inflated away, and that's a big problem for an energy importing nation. They won't have they will, it'll be harder and harder for them to import the things that they need. So ultimately, they have to keep their rates, where they are, because the U.S. have kept their rates as high as they have for as long as they've had. So I think this is a bit of the fallout from, as Trump likes to call him, too slow Jerome, or whatever, from keeping the rates as high as they have in the U.S. for as long as they have, right? Whether you agree with it or not, that this is the kind of the likely conclusion of it, right? And so I'm not sure we're going to see a lot of movement on that unless we see U.S. Rates in the U.S. starts to fall, which will take the pressure off the Japanese market, which will take the pressure off the Japanese investors unwinding their carry trade.
So in the meantime, like, what does that mean for investors in Canada? Like, what do we do right now with this information? Because obviously this isn't going to be like a long-term, struggle session. Like, how long do you think this is going to last? And what should our viewers be doing right now as their investment strategy?
Not. It's a good question, Trevor. Not panicking, not panicking. So remember, when I zoom out on that yield chart, that's not a big deal at all, right? When you zoom out and when you look at the 3 month chart, it looks pretty scary. As soon as you look at a 6 month chart or a 1 year chart, it no longer looks that scary. So I think what you need to do is maybe uh, put a little less credence on, is the Canadian bond market blowing up? It's like the Canadian bond market went up by 20 basis points today. That's not blowing up. And in this day and age, which is much with as much debt and stress in the system, we should expect this volatility, right? And I think that's going to be, some of our topics as we move forward here is I would be expecting more than normal volatility for 2026 because there's basically just a lack of liquidity in the system. And so people are going to see more volatility, and the kind of the market's designed to move the money from the impatient people to the patient people. And I think there'll be a lot of there'll be a lot of movement this year that will tempt the paper hands to part ways with their investments. And so, um, is it a little bit concerning when it goes up? Yeah, it is. But this should be expected at this point. We have nations around the world where their debt to GDP is increasing to historic rates, and ultimately, that's going to put volatility and downward pressure on some assets. But ultimately, what's the counterplay is to move money out of assets into currency that we know is going to be devalued. Like we
Hmm.
just don't know the timeline, and that's going to create the volatility. And so the temptation will be say, okay, well, I see this is a stress factor. I'm going to take the money out of the market and I'm going to put it into cash or short-term money markets. But the problem with that is the release valve is the currency. There's only two release valves, and that's balancing the budget or that's devaluing the currency. And pretty much we would expect all of the Western governments to do the same thing, is to devalue the currency, because people like to vote for so-called free stuff, which they don't know is just
Mhm.
funded by printing new money and basically devaluing the existing currency.
Yeah, I was just going to ask that. Like, how is this going to be affecting the money supply, the M2 money supply worldwide as well as United States and Canada?
Yeah, I mean, ultimately, the money printer's heating up. We know the U.S. banking system is largely running on fumes right now, and I think we're going to, probably put that as a large focus on what to expect in 2026. And so, it is largely running on fumes, but how they, you know, uh, re-liquidate that, re-inject capital into that system, how fast they inject capital into that system, and how fast that takes effect in the actual money supply is largely unknown. Like it's largely unknown because they haven't ever done quantitative tightening for this long and this steep before. And so we can speculate, but we have nothing to compare it to because it's just never happened in the last, 53 years or a fiat system. We had a much more gradual quantitative tightening, leading up into 2019. But this was a much steeper quantitative tightening, and we've come to the end. So it was just like, when they injected all the capital during COVID, the inflation was relatively certain, but there was a time delay. They injected a lot of that capital right away in 2020, but people didn't see those inflationary effects until 2021 and 2022 when it kind of peaked. And so it's going to be the same thing this time. Is they're going to put capital back in the system, whether it's this month or sometime in 2026. But even when they put it back in, how long? It's like a time delay fuse before you actually see the increase in the money supply and the appreciation of asset prices.
Yeah, and another thing that we haven't really touched on is the reverse repo market. Like, how much do the banks have? Like, what can they borrow? Like, what is that looking like right now?
Yeah, they don't have a lot right now, and I think we'll probably drill into those charts next week when we'll look at the reverse repo market and the overnight repo market. Effectively, the banks are their savings account has drained, the reverse repo market has drained, and now their repo operations, they're actually in their overdraft account, and we can see that. And the Federal Reserve knows this. This is why they ended quantitative tightening at the end of November. But so far they haven't overtly said quantitative easing, although we we expect it collectively because we know the stress that was under the system. We're probably waiting. I've been telling people we're waiting until January when we're actually going to see the reports where we'll see what the use of the overnight facilities are at the end of December when they have to be in compliant assets for their year-end reporting. So right now we don't know, and the injection of right now the kind of the volatility in the bond market, it's actually, in my view, it's actually pretty moderate volatility compared to the stress that's in the system right now. So I would tell people this is largely a nothing burger in the scheme of things. It can be a reason where paper hands would fold, but your only real option is to fold into assets, which are effectively
Mhm.
cash or short-term investments that are near cash. And ultimately, we know, the longer we hold cash or the longer we hold bonds, the risk of inflation is virtually certain.